Here. I'm excited today. We've got some great information as Cory shared with you. I've got some things I'm going to talk to you about, and I'm going to start. There we go. Go to my next slide. So I want you to stick around until the end. We have some people that we want to honor. You guys have, thank you. We'll get it all together. This it's happening in real time, folks, real time. So we've got some people that we want to honor who have been really instrumental in helping us to build our practice. And there have been changes that we have made in our office in terms of how we do the work that we do, how we interact with our clients. And so we want to talk to you a little bit about that and how that's going to impact you. And then how you can get involved with helping us expand EFC. We know that birds of a feather flock together, and so the more that you're able to tell people about who we are, the better off that is. So we're going to start with... We're going to do awards first. Yeah. Oh, we're going to do awards first. Okay. Who should I start with?
Gotta keep her on her toes.
You do. Yeah, just switch it up on me. Yes.
So let's start off with elite ambassadors.
Okay.
And then we'll pull them up.
All right.
I'm going to talk about the elite ambassadors, and then I'll just kind of briefly, and then we'll pull it back up and slide it down.
Sure. So one of the ways that you can be a part of EFC and help us to grow is to be one of our elite ambassadors. And what that means is sharing your EFC experience with friends and family, letting them know who we are and inviting them to consider us as their financial advisor. And so part of being an elite ambassador doesn't mean that the person that you have referred has necessarily become a client, but it means that they have at least come to that first meeting and given us a chance to meet them and introduce ourselves to them. And so we want to take an opportunity to acknowledge some families that have been really important. I want to start with Rosa Huerta. Is there a Rosa? Yes.
Come on up, you're in.
Yes, welcome. So sometimes you wonder, who do I refer? And that person that you refer can actually be a fellow retiree. Many of you are coming out of corporate positions and you are next to people that are retiring, or you guys have kind of been in the same cohort moving through the corporate structure. That's a great person to recommend, because everyone's needing to figure out, how am I going to manage the assets that I've spent my whole working career building up. You can also, there may be somebody in your circle who needs a second opinion. And that's a great person to refer to EFC. There is no obligation, and you know this because you guys have come into our office, there's no obligation to do business with us. But we do offer a second opinion, and we will look and give you an honest assessment of of where you are and how your portfolio is performing. So with that, I'm going to start now with the Bennett family. Yes, Darnell and Robin. Woo! Okay, yes, right. Okay, everyone has to top that next. So yeah, okay.
Recently retired this week.
Yes. Sometimes one of the things that can happen that will, kind of move you into an advisor's office is that there's a life event. A life event could be the sale of a home. And so what do I do with the proceeds from that? A life event could be the transition of a loved one. A life event can be an inheritance, or a life event can be, anything that sort of upsets the apple cart. If there are people that are in your life that fit that criteria, they're probably someone that might be a good candidate to come into the office and sit down and talk to us. All right. May I have the Hayden family, please? Mr. Patrick Hayden.
Every time he comes, I feel like I gotta go to the gym and work out.
Thank you very much, Mr. Hayden. Who we got next? So do you have it?
Yeah.
So we have someone who has been, when Cory and I were talking about it, that we said, you know what, we need something that's like the Builders Award, because every time we turn around, they are, say that? Okay, not that part yet? Okay. All right, so now we're going to pivot. All right. May we have the Weiss family, please? I love it.
So I gotta tell you guys something. If you're ever looking to get some breakdancing tips, Mr. Weiss here. You guys involved. If any of you guys saw the video on my Facebook page about him breakdancing and doing the worm, it was amazing.
Oh boy. That's the last time we'll see.
Awesome, awesome. And these are families that have basically introduced new people. Some of you are here with them. You're friends of ours. You're part of the family because they have introduced you to us. May I have the 𝗀𝘃𝗲𝗰 family? 𝗀𝘃𝗲𝗃𝗲. Yes. Ma Evelyn and Renato. But these are families that have introduced EFC to their friends and family. And again, it doesn't mean that the person has become a client, but it means that they have taken that first step to have a meeting with us, to meet with us and understand what it is that we do and how we can support them at EFC. And this is really important for us because what it does is it helps us keep our costs down. It's different if you are spreading the word for us, if you're being our ambassadors, then that means that that's less money that we have to put into advertising and more money that we can put into something else. And so this is why we're taking this time to just share with you our friends of EFC who have really helped us to build the firm out. Who do we have next?
So let's just list off the names that are not here, but they have their awards. So this is Brian and Sheila Carlin.
Okay, yes, we have some people that are not here today. We have Brian and Sheila Carlin, Jennifer Nolte, the Cox family.
Sure, you have an opportunity to tease him for not being.
Oh, listen, I am actually sparing him. Okay. I didn't knock the age down. No, what's funny is in the office, because we have a couple of young people, right, we have a couple of young people in the office, and we will ask them, come here, what'd that say? This is the 𝗀𝗃𝗲𝗰 family. And it's at the point now where it's no shame. If we have to, go out to eat, and the bill comes, like we have readers, we might be at a meeting. I've got my readers. Cory doesn't have his. He takes mine. Now I've got to go chase around the office and figure out where he left them. So generation.
About the Black Club before we do that.
Okay, great. So the Black Club, I want to talk a little bit about our Black Club. So these are friends of EFC who are some of our highest net worth clients. But it isn't just that they're our highest net worth clients. They are our highest net worth clients, and they have told someone about EFC and introduced them. And with the Black Club, one of the things that comes, and I'm sorry, and why I'm highlighting this, let me say this, because you guys know you got an email, we changed our parking policy, and so we no longer validate parking when you come to our office. Parking is on you. However, for our ambassadors, our elite ambassadors, and those that are part of the Black Club, parking is validated. And so this is our way of saying thank you for helping us build this firm. Thank you for helping us expand the EFC family. And so these tables here are Black Club and a few that are here in our elite ambassador. But those that are part of the Black Club get invited to private VIP sporting events. We have some private dinners with the founders of EFC. We have VIP seating at all of our client functions. We have quarterly update calls as needed. We have priority access to Cory's calendar, which if you have ever tried to get on Cory's calendar, you know. You know. We have priority access to... I got the mic, I can say whatever. Right. But you also have a client liaison, someone who is there to support you and make sure that all of your questions are answered in a timely manner. Priority access, thank you. Priority access to Cory calling you back within 4 hours. And then other things that are to follow. But these are the families that are helping us to build out EFC, and we are so grateful for them. You got the first one for me, Cory?
Yeah.
Okay. So I want to start with John.
Well, before we do that, I gotta keep her on her toes. I keep saying that. So I just want to add one more thing. So the Black Club to me is really a group of individuals who I feel truly embody what our firm is about. They are, for all intents and purposes, the people who will always show up for us, which really means a lot to us, right? From everything from events that they come to me asking questions on the best way to articulate to our clients and get communication out to them, what we're doing wrong, what we're doing right, especially about what we're doing wrong. They definitely will tell me. But these are what we look for, because the Black Club for us is really the peers of you guys that gives us the ability to make sure we're doing a better job, right? So they really hold us accountable, right? So I probably talk to them quite a bit, is largely because of the fact that they're there to help us shape our company, and that's a big deal to me. So I want to thank you guys as being a part of our Black Club, those of you guys who are sitting in these front 3 rows, because I appreciate all that you guys do to help us grow our practice, okay? Not only because you guys are great referrers to other people, but you always have an ability to kind of tell us when we're doing things wrong, so that way we can try to make it better. And you don't jump to decisions right away, but you help us kind of grow through the process, because we're not perfect. We're going to make mistakes, but at the end of the day, you guys have enough wherewithal to at least have a conversation with us, which I appreciate. So I just wanted to point that out. One of the things that we like about this Black Club is we went out and got, I know you guys know what the American Express Club is, right? So American Express has something called a Black Card, right? And this is where the premise came from, because the Black Card is like, it's a Centurion card, and it's like the most expensive, most illustrious card you can have in American Express. So that's why we came up with the concept of the Black Card in the Black Club. And so if you have this card, this gives you carte blanche to pretty much everything in our office, right? From time on my calendar to time to sporting events. Whenever I'm thinking about, hey, we got tickets to the Rams or Chargers or something like that game, we're reaching out to you guys first so you can take full advantage of it, right? Because we want to always love on you guys and pour back into you that. Now, the funny thing about it is that Sherry had said about it's our largest asset base. Quite a few of you guys have larger assets, but the only way to get on the Black Club is you have to have the assets, plus you have to refer business to us, right? That's a big thing. And it's almost as simple as getting one person to come and having a meeting with us. We're not asking them to sign up, just if they show up and come have a meeting with us. That's a simple way to get on board with our program, because the assets in here, there are quite a few of you guys that have the asset base to be on board with that club. So I appreciate you guys once again. I just wanted to make sure that we kind of talked a little bit about this card and how important it is. It should have your name on it. Those who don't have names on it, we're going to have them engraved on these. The cards are pretty expensive. They're metal, just like American Express cards, so you'll feel the weight on them and stuff. And bring them when you come into the office. This will definitely make a big difference when you walk in the door. Okay, thanks guys. So.
All right. So now, I would like to acknowledge John.
It does not have the same credit limit as the American Express Centurion. So let me just say that up front, okay? It does not, okay?
Is it my turn now?
Broke by the end of the week. I can see this now. All right.
Okay. Now I'd like to acknowledge John and Carmen Ramos.
All right, come on up, guys.
Can we get our tickets validated or?
Yes, yes.
Okay, let me let you take the picture. Thank you so much. Okay. Okay, all right, very good. Next, we'd like to acknowledge Robin and Darnell Bennett.
This is getting old. Thank you.
Thank you so much.
Thank you, guys.
I'll take it. Yeah. All right. Mercy. Hayden. Right. All right. Next, we would like to acknowledge Patrick and Regina Hayden.
You gotta carry both.
Come home with gifts.
All right. All right. So I'll take this one.
Okay.
So there comes a time when you have a very unique individual. It's not working. There comes a time when you have a very unique individual. And at the end of the day, I wanted to take time out to acknowledge this person because she's just fun, okay? We have a couple things for her. She's the top builder in our office. What I mean by a builder, our whole concept is called the sound fiscal house. So many of you guys know we talk about the sound fiscal house. So when we talk about our analogies, they all have something to do with building a home, right? And if you ever gone to a planned development or anything like that, you know there's a number of builders out there, right? Toll House or Toll Brothers and that kind of stuff, right? And so for us, we look for the person who has really done a great job at referring and helping us grow. And it's funny because she did it without even trying, which is the fun part. And I literally had to call her and I said, you need to be here no matter what, right? And but she just doesn't want recognition. She's happy about being retired, having a good time, relaxing on her own, and just being in her own time frame. So I appreciate it about her. But I wanted to take a time to tell everybody, if you could please give a big warm round of applause to our #1 builder, our biggest supporter. Not only did she invite a lot of people to come see us, but she had the most people that sign up in our new organization over the last year. And I want to say, Linda Richardson, come on up, please. Thank you so much for everything. No Neiman's, no Rodeo Drive, no. All right, I'm gonna hold on to that because I gotta get more certificate. So there's 2 people in the room, or actually 3, that I apologize that we missed out on. During the COVID timeframe, we weren't able to do, of course, our annual event, and I didn't get a chance to acknowledge those 2. So I want to make sure that Judy Nito in the back, can you send up Judy? Congratulations, you're a star ambassador. So I really appreciate it. We'll make sure we have your certificate and your award by the end of this. And then last but not least, Eric and Paul Mitchell as well. Once you guys come up, I have your certificate. We'll also have your star come in. We had to order it separately. So I want to thank you guys for coming on up. Sure, I'll come by and get my water. Okay. And I think that's it for everything. Okay. All right. Sure. Yeah. So the other thing we'd like to do is acknowledge the people in my office, and this is kind of coming from me directly. We have a new gentleman on board that's been with us for this last year and has made a significant change in our company as far as having someone who focuses on and specializing in the insurance services area, but more importantly, top producer. And so we have a top producer award, and this is going to go to Mr. Antoine Turner.
Really?
Good stuff, man.
All right, man.
Good.
Thanks. That means more.
Shay, can you open it? Okay. So. You got it?
I got it. This one's over.
No, I need this one. What's this one? What's your name? Okay. So many of you guys talk to this young lady all the time in their office, and in our office we call her a precious gem, and I want to acknowledge her for all her hard work and the things that she does. I'd like to have Miss 𝐒𝐿𝐼𝐍𝐃 𝐻𝐿 come up, please. Yes, you. As she just strolls on up, casual. You're hilarious. Yeah. So, this person that I'm going to acknowledge right now is truly my left hand, and she does everything under the sun. It's hard to work directly for me. I know this, okay? And but she knows I love her to death, and at the end of the day, we have a lot of fun, and we do a lot of cool things together. So this is going out to the ultimate team player, and that's Miss Sherry James. Get her camera. Get Lila's camera going. Take a picture. So I have a couple people not here today, but I do want to acknowledge someone who is my right hand and probably the most important woman in my life, next to my mom. And by the way, this is my mom over here in front. Y'all saw I cleaned that up, right? You know that, right? Okay. So, you know, when I was thinking about a perfect title for her, I came up with indispensable, and that's my wife, 𝗀𝘃𝗲𝗰 Chapman, and partner. Lord. All right, let's get this thing started.
It's okay.
All right, so Sherry, let me introduce everybody to come up now. Let's get started.
So I'm going to call our speakers. I'm going to call first Tim Sargent, who is joining us from Sterling Capital. Did I did say okay. May I also have Mark Sumi, who's joining us from First Trust. I'm already up here, but I'm going to call Antoine Turner. Yes. And Mr. Cory Chapman. So I'm going to start with Tim. Tim, I'm going to call you up and pass the mic to you.
All right, thank you very much. I appreciate it. Everyone here, thank you so very much. Appreciate everyone coming out this morning. It's a gorgeous, beautiful day here in Southern California, especially from someone who lives in North Carolina. It's a little bit different, but certainly appreciate everyone coming in. Thank you so very much. I want to say thank you very much to Cory. I want to say thank you very much to the whole EFC team, organizing and so forth. So thank all of you for this morning. So I've been told to keep it to about 20 minutes, which for me is very hard. I can introduce myself for 20 minutes. So what I will quickly do is introduce myself, talk about the firm for a moment, kind of review the glorious year that 2022 was, talk about what we think about 2023, how we're positioning to take advantage of what we see and maybe sidestep some of the things we also see. And then, we'll answer some questions at the end. So, all right, that being the case, a little bit about me, a little bit about the firm. I have earned all the gray hair on my beard. I have been doing this since 1997, and if you carry the 2, that puts me at 25 years, right? I've been doing this a minute. I've seen good years, I've seen opportunities to buy, and everything in between. I am from the great state of Ohio, is originally where I'm from. That's where I lived the first 30 years of my life. It's where my daughters were born. But then in 2004, then moved on to North Carolina. So, the firm, who is Sterling Capital? Well, I'm glad you asked, right? All right, so we are an institutional money manager headquartered in the great state of North Carolina. When I say institutional, what do I mean by that? All right, show of hands. I want to get some interaction going and continuing. Okay, who here has heard of the state of Florida? All right, okay. Who here has heard of Amazon? All right, who's tripped over an Amazon box recently? All right. And then who here has heard of the Ohio State University? There we go. I see some OH. All right. So the reason I brought those 3 up are those are 3 of our clients. Certainly we have many, many more, but that's a state, that's a school, and that's a corporate client. Just kind of gives you a little bit of a flavor for who has trusted us with their resources. And the same intellectual capital working on those accounts are working on yours. All right, so we don't have a different set of capital market assumptions, what the Fed's going to do, what interest rate's going to do, all this kind of good stuff for some clients and not others. So that's quickly who we are as a firm. All right, so I got through that quickly. Sterling Capital, me. All right, so let's recap 2022. All right. It feels like just a year ago I was out here talking with everybody, and it was a beautiful day, similar to today like we had talked about. Different location, but still I can see the ocean from here, which is a little bit better from a view than I get from Raleigh, North Carolina. But 22 was a bit of a challenging year, right? I don't think I need to tell anybody that, generally speaking, this wasn't the best year for anybody. So let's kind of walk through what kind of led 22 and then what we think is going to guide 23. All right, so who here is sick of hearing about the Fed and inflation? Pick me. I am sick and doggone tired of it. But that's really what drove 2022, right? A year ago, there were $18 trillion worth of negative yielding debt. What does that mean? That means if I bought a bond from you for $1,000, you gave me less than $1,000 at maturity. There was $18 trillion worth of negative yielding debt globally a year ago, or roughly a year ago. There's zero today, right? Rates have gone up dramatically. A year ago, a corporate bond was going to get you right around 2%. Now it's going to get you a little bit greater than 5.5%. Right? So rates have gone up dramatically. Why? What's been doing it? Again, not to drag this on too much, but inflation kind of reared its ugly head. I remember back when inflation was just a wee little thing and it was just transitory. And then it grew up and it turned into a high score that drove all of us crazy. And the good news is now it's kind of on a downside. But to beat inflation down, the Fed or the Federal Reserve just had to raise rates to slow the economy down. Like, that's the playbook. And that's what they did. And they did it extremely well for inflation purposes, not necessarily for investment purposes. In fact, the first 6 months of the year, right, again, carry the one, that's June, right? First 6 months of the year, it was the worst first 6 months of the year since in the treasury market, the bond market for government securities, since before George's first administration. And of course, when I say George, we all know I mean Washington. 1788. Okay, I see a lot of experience in the room, but no one was around, right? So it's been a minute since we've seen something like that happen. It was a challenging year for the bond market, and we saw that because the Fed was raising rates. Then the stock market, right? Well, because we've all heard if one does bad, the other one does good, and vice versa, right? Not so fast, my friends. The equity market, what happened? It was suboptimal, I guess is how we'll put it. It was down. And what really drove it? Again, the same phenomenon. The Federal Reserve raising rates. Why, you ask? Well, multifaceted. One, this is nerdy, but bear with me. A company's value is the present value of all of its future cash flows. Just remember, a company today traditionally is all the cash flows it's going to make forever discounted to today's dollar amount. You have to use some sort of math to make that happen. Long story short, as interest rates go up, that changes the math and makes that present value worth less. All right, sorry about that, but that's it's one of the things we had to go through. The other, and kind of what we're seeing now, is, oh my gosh, the Fed's going to throw us into a recession, right? And who here is old enough to remember all the way back to the summer of 2022, right? So 2022, I remember we had an argument as a country of what a recession is and isn't, right? I'm a student of the 90s, right? So there's some years in the 70s, maybe some of you don't remember as well. There's some years in the 90s I don't remember quite as well. It's when I went to school, but what I can say is I was always taught shorthand, 2 consecutive quarters of contracted GDP was shorthand for recession. That's not the technical term, but we've been kind of battling back and forth as a country, depending on who you cheer for, what that means. So that's really what has pushed last year. Know what the great thing about last year is? You were working with Cory and it's over, right? So it's over, it's behind us. So now the question is, now what? 2023, what do we think? What do we see? Please give me some guidance, right? All right, so the state of the economy for 2023 is meh, right? Just kind of, It's kind of shrug emoji kind of thing. What I can tell you is at Sterling Capital, and I believe if you consume any kind of financial news, essentially there's a lot of pessimism economically speaking, right? Most people believe there's going to be a recession in 2023, all right? Who has heard that, read that, seen that somewhere, right? So some have heard that. And we're in that camp. And you're going to hear a lot of scary things economically speaking. And the reason I tell you that is A, not to scare you or have Cory come up here and wrestle this mic from me or something, but I want to be very truthful with you, because if you know what's going to come, it makes what's coming a little easier, right? Some people say ignorance is bliss. I ask my wife, I'm an oversharer, right? I over-communicate. So it's important to know that we believe, and most people believe, there's going to be a recession. The question is it going to be a deep recession? Is it going to be a shallow recession? How does that look? Now, that is data dependent, right? So we'll see what happens with that. But economically, we think it's going to be a bit of a challenge. All right, why do we say that? Okay, there's leading indicators, coincident indicators, and lagging indicators. Just quick little school. There'll be a test at the end of this, by the way. Take notes. Leading indicator is a data point that gives us a glimpse into what might happen in the future. Leading. Coincident, what's happening right now. Lagging, what happened in the past. It's good to have all those data points as we have a mosaic to what we think is going to happen in the future, but that's what we're looking at. Quickly, employment, which one of the leading indicators is, it's not unemployment, but it is, it's an employment data point, and I'm sorry, it's escaping me, but essentially it's ticking downward, right? So it's moving in the wrong direction with regard to employment. Initial jobless claims. There we go. If I stammered long enough, I'd come up with it. Initial jobless claims are moving in the wrong direction. Another leading indicator would be ISM, Institute of Sales Management, not important, but their indicators are showing weakening of the economy in the future. And then housing, okay? So being here for the brief period of time I've been here, housing doesn't seem to be much of an issue here, but it is slowing, right? So I live in Raleigh, North Carolina. It's actually one of the fastest growing communities in the United States. I was talking with some folks over here. I didn't realize I was talking to royalty at the time. That'd have been nicer. But what I can say is it's just growing like crazy in Raleigh. I always joke that I can't believe there's anyone left in New York and New Jersey because they've all moved down to my neighborhood. And what's happening is a year ago, 2 years ago, if you got full ask on your house, everyone put their arms around you and hugged you and said, I'm really sorry you didn't do better than that, right? It was a knife fight in your front yard because people wanted to buy your house so much. That has not happened recently, right? That's what the Fed's trying to do by raising interest rates. It's making the cost of buying a home significantly more challenging. I imagine for most of us in this audience, we already have our home, we already have our loan, or it's already paid for. But our kids, our grandkids, and by the way, I'm a grandpa, or I should have mentioned that. So for all the grandparents out there, I became a grandpa in October, so I do have to worry about grandkids these days. So I am old. All right. So they've got a bit of an issue, right? Because interest rates a year and a half ago were significantly less than they are now. So the Fed's kind of pushing us this way into the recession. So not only do we think the Fed's going to make a mistake, but also leading indicators tell us as well. So that's the economy, the economic part of it. All right, so now I have to kind of pull this from this downward spiral into something good, right? A Okay, now what? You've told us the bad news, now what? All right, the stock market and the bond market are supposed to be forward-looking mechanisms, meaning it's not supposed to tell us what's happening today or yesterday, but what's going to happen in the future. All right, who here thought the stock market was down last year, right, all of us? Okay, because it was down, it was telling us, the market, that they think the things are going to slow down. So the market has priced in a decent amount of this economic headwind that we see coming. So that's a positive. A couple other data points. The Fed, historically speaking, when they get done raising rates, and by the way, they should be done around March, April, right? They're going to meet the first week or first day in February. They're probably going to raise another quarter point, 25 basis points. They're going to get together again in March. They're probably going to raise another 25, and then they're probably going to pause and be done. That's awesome, and that's a technical term, by the way. It's great. So what we believe then is, historically, when the Fed has done raising all the rates, over the next 12 months, historically, the stock market is up almost 15%. That doesn't stink. If you take a look at officially what a recession is, which is the NBER, essentially when they say, hey, there's a recession, going all the way back to 1871, once they said there's a recession, the next 12 months, stock market's up almost 15%. And once you hit a bear market, which is market down 20%, FYI, we had one of those. Historically, the next bull market is up 167%. So, yes, economically, we're going to hear a lot of bad things on the nightly news, but when's the last time the nightly news said, hey, go out and play with the kids and grandkids, it's 75 and gorgeous and there's a big ocean next to you? No, it's like, oh my gosh, calamity, right? Tune in next. And then they're selling you cars or razor blades or pharmaceuticals, right? So we think economically it's going to be a challenge. But that being the case, we think the market is going to be higher a year from now than it is today. We are positioned that way. We are overweight stocks versus bonds. We do think rates are going to go up. Rates have actually come down on the 10-year pretty precipitously since they hit their highs back in, I think, October. But we think rates are going to go up a little bit. So we're underweight bonds. We do like smaller companies. We think they will do well. And we think emerging market companies, right? So think, I hate to say it, but you can't say the word China anymore without getting booed, but we think China's going to do pretty good this year, India and so forth. So we think those are pockets of opportunity. So that's where we are more heavily positioned and hiding from some of the places where we think there's more volatility. So economically, a bit of a challenge. Market priced the vast majority of all of that in. We believe there's going to be ups and downs this year. The market does not go up straight or down straight. And one of the great things is when you work with Cory, you have the opportunity to work with people like us, but also you get to work with First Trust. And I'm not going to plug them too much. They can do it themselves. But what I can say is we are a nice complement to what they do. And they are a good complement to what we do, which is probably why Cory wanted to have the two of us come up here and talk at the same time, because we are a nice yin and yang. So I can't wait for the Q&A. Thank you all very much. Cory, thank you very much. Everyone have a wonderful morning.
So I'm actually going to open it up for maybe one or two questions. If we have one or two questions, and then we'll go to our next. And we'll have Antoine next. Okay, so I'm going to actually go to Antoine next. Oh, okay, you're going to pull it. Okay, so Mark, he is going to pull it up. He is, yep. All right.
I was going to say, you guys are about to have the opposite of a grand finale if I was last there.
He's going to, oh, right here.
All right. While Cory's pulling that up, Tim had to fly here from Raleigh, but I had to walk here. I had to use my legs. I didn't get to sit on the plane and watch Netflix and have a watered down cocktail. I had to walk here from my apartment up the hill. Having said that, I think this is a tremendous venue for this event. I think it should be held here every year. All joking aside, though, I do quite a bit of these, and this is a top-notch event. I mean, there's a real celebratory atmosphere in here, and there's a lot of joy, and that's really apparent. There's a lot of authentic smiles, and I'm not, saying all of you have those, because I don't want to compliment everyone in the room, but there truly is, and it's cool to be a part of. So I appreciate Cory and the EFC team having me here to tell some mediocre at best jokes. But all joking aside, it is great to be here. And like I said, most of these are snooze fests. Speaking of snoozing, the coffee is still relatively fresh in your system. So even though there's a PowerPoint coming up, no excuse in dozing off, okay? Unless you were out past midnight last night, which looking in this room, I don't think many of you were. Hey, I wouldn't either. I was in bed at 10. All right. You know what? The clicker. I don't know if the clicker's working, Cory. Is it on? It's not on. Yep. All right. Well, tech problems never happen. By the way, this is rare. But while we're figuring that out, First Trust, who are we? Most of you probably have not heard of us. That's because we don't advertise at all. All of our resources we pour back into our advisor relationships with teams like Cory to support them in any way we can, and then also into our products to develop and create the best and manage the best possible products we can have for you, the end clients. And today we're going to talk about some of those. First Trust as a firm, we manage, again, you probably haven't heard of us, but we manage about, still not working, that's okay, no one wants to see it anyway. There's brochures in back. So these pamphlets here will go over a lot of what I was going to cover in the exhilarating PowerPoint anyway. So don't get too sad. But again, First Trust private company, we manage about $200 billion. We've been the fastest growing ETF. An ETF, most of you are probably aware, it's an exchange traded fund. Fastest growing ETF firm in the country for the last 7 years. Blah, blah, blah. That's cool, Mark. Thanks for patting yourself on the back. That's not why I'm saying that. It's because what we're going to talk about today is our ETFs that have been the fastest growing in our history, and that has only been amplified in the last year. All right, still? No. Yeah, that's okay. We'll make this quicker. So why have these been growing so fast? The buffered, these are called target outcome ETFs, also referred to as buffered ETFs. Why have they been growing so quickly? It's really just an awareness thing. So as simple as that sounds, most people are still not aware of buffered ETFs. They're relatively new. They've been around about 3.5 years. But again, they've been growing exponentially to the point where there's now about 10 billion under management. We'll skip ahead here. So who's familiar with the S&P 500, first of all? All right, everyone. And that, I know you are. I just did that to kind of wake everyone up. But what we're going to talk about today, everyone's familiar with the S&P 500. A theme, and it's a great follow-up to what Tim just spoke about, but a big theme these days is how do we protect our portfolio? How do we protect the wealth that you've worked so hard for every day, hopefully in jobs that you enjoy, but if you don't, then you want to protect it even more, don't you? So how do you protect the wealth that you've gained in a market like today? Well, in the past, it would be with an allocation to something like, 60-40 portfolio. And who knows what a 60-40 portfolio is? Nobody. Good. So that's 60% equities, 40% bonds. So the idea there is that, equities, they give you a little more potential upside, but then the bonds help serve as a ballast in your portfolio and protect the downside. Now, okay, that's great. That worked for many years, for decades. But last year was the worst year for a 60-40 portfolio since the Great Depression. Let that sink in for a second. That's a long time. I'm not going to make any age jokes. I've already done, and Tim did some too. But it's a long time. So that whole kind of paradigm has shifted. So now going forward, especially when duration risk and interest rate risk is becoming more and more amplified, how do you protect your portfolios? And that's what the buffered ETFs that we're going to talk about today, that's the problem that these help solve and why they've been growing so quickly. So simply, it's going to be invested in the S&P 500, an ETF that gives you exposure to the S&P 500 with the first 10% of downside covered. It's on the house. It's my pleasure. It's on us. So if we're down over 10% over the course of the next year, you lose nothing. If we're down 12%, you only lose 2%. Okay, well, what do you have to give up for that quote-unquote insurance? And that's really what it is. We talked about protecting your portfolios. That's another way to look at that is getting insurance on your portfolios, which bonds used to help mitigate that risk. Again, the 60-40 portfolio, it's been a rough stretch for that, but then even further looking at the correlation between stocks and bonds, you don't want them to go the same way if you're using bonds to help protect your portfolios. Well, the correlation between stocks and bonds is the highest it's been in over a decade. So that's another reason that the strategies like this are growing so quickly, to help get insurance, so to speak, on your portfolios. We get insurance on our cars. We get insurance on our homes, right? The likelihood of ever having to use that is very unlikely, a percent or less, especially when you're looking at something like your home. Now, insurance on your portfolio, why would you want that? Well, over a quarter of the time, 27% of the time, the S&P 500 has a negative annual return. So in that case, if you have something like this, a buffered ETF, those, 1 out every 4 years, historically, when you have a negative year in the S&P 500, this is going to help protect that downside. All right, everyone's still awake. Good. Next slide. There's only 65 more, okay? So like I mentioned, there's a capped upside. That's what you have to give up. That's the cost, so to speak, of the insurance. You have that 10% buffer on the downside. What do you have to give up? You're capped on the upside in the S&P 500. Let's look at a couple scenarios to see how that works. So in this first scenario, say we're down 20% this year. We all hope that doesn't happen. But if we are, again, you're only down 10 because that first 10% is covered. The first 10% of downside. Oops. That's why you get insurance. All right, I'm out. No. Next scenario, we're down 10%. So can someone tell me how much will you be down if we're down 10% the next year? 0. Look at you guys. That coffee is working. The next one, we're up 7% next year. You're going to participate in that. You're going to be up the same amount, 7%. In this final scenario, we're up 20%. You're going to be capped at 10%. Okay? Now this hypothetical example here uses a very conservative cap. We have the January series that's resetting of these S&P 500 buffered ETFs, and that has a cap of 18%. So much more than this hypothetical example is showing. This PowerPoint likes to do what I do, under promise, over deliver. So set the bar low, so to speak. And this is how the ETF will trade throughout the year. It will give you the same directional correlation with the S&P 500, but without the same amount of volatility. It's going to have about half the volatility. So the blue line there is the buffered ETF. The orange line is the performance of the S&P 500. You can see when it's down, it's not going to be down as much. And then as we get to the end of the 12-month outcome period, it's going to be moving in lockstep, really one for one with the S&P 500. Why is that? Well, not to get into too many nerdy details, to use Tim's word, but it's options, which is what gives you the exposure to the S&P 500, okay? Options, as they get closer to their expiration, which is the end of 12 months here, they move really one for one with whatever the underlying security is. In this case, it's the S&P 500. This goes a little bit more into the nerdy stuff. We don't need to do that. We also have these same buffered ETFs tied to 𝗀𝗃𝗃, which is a tech sector ETF, the most popular tech sector ETF. Tim mentioned international is something they're more bullish on this year. We have an international buffered ETF that's tied to EFA, and that's, I'll stop there, man, because I've probably been going a little too long as it is, but questions later, is that right? Okay. Yes. Yeah. And I should say, and thank you for asking that. So the question was, do these ETFs, so the January series, does it reset next January? Yes. And what does that mean? And the brochure will help explain that as well. But what does that mean? It's going to get, say we're up 15% over the next year in the S&P 500. You're going to capture that full 15%, okay? Because the cap for this January is 18%. Then at the reset next January, you're going to get a new 10% buffer for the following year. So now you're going to, those gains that we have, you're going to have protection on those. So say you put in 100,000, now it's at 115,000. You're going to have a 10% buffer now on that 115,000, and then you're going to have a new cap going forward for the next year. Now the beauty of being in an ETF wrapper like this, so to speak, is that there's no taxable event when they reset the ETF each year, which means until you decide to sell it, and I don't know why you'd ever want to do that, but until you decide to sell it, there's no taxable event. It just keeps perpetually rolling each year. The January series is the new one right now, but there's one out there for each month of the year that you can kind of go and look at and decide, and Cory can use his expertise and his knowledge of your particular investment goals to decide exactly which one with the amount of remaining cap and buffer make the most sense for your portfolios. So again, thank you for having me, Sherry and Cory and the whole team.
So guys,
That's great.
so one of the reasons why I brought these two gentlemen out is that going into the new year, our job is really to try to anticipate what's being happening, right? And that's literally, I thought this mic was working, maybe not. Okay, got it. Okay, doesn't work, okay. Sorry. So our job, like I said, is really to try to help anticipate what's going on in the economy. That's what you're paying us for, right? Our job is to try to figure out the things that are going right and the things that are going wrong. But more importantly, bring in the type of things that we can help offset whatever that we think the economy may do, right? I really like this strategy he has from the standpoint of these cap rates, because it reminds me a lot of annuities, guys, right? So a lot of you guys have that same annuity for that reason. It's the ability to know that no matter what goes on in the market, there's something going to protect the downside, right? That's why we ended up using the annuities in the first place. Well, now we actually can do this the same way with our investment portfolio, right? And be able to come up with a better strategy to kind of offset some of the losses from the markets that are in our roof, right? The roof section of our house. And so I thought this was a great complement to what we were talking about, and that's why we're starting to use these now into the portfolio. So a lot of you guys are going to hear me talk about the very end called 𝗀𝗃𝗃𝗃 and talk about your risk scores. What we want everyone in the room to do is make sure you reach out to us so we can set up your new risk score, okay? Things have changed. When you first started investing with us, you may have felt one way about the market, where now you may feel a totally different way. I know Sherry has sent these links out quite a bit, and not a lot of you guys filled them out. But it's important because this is how we make determinations of what's going to be the right fit for your portfolio. Does anybody get that? Okay? So what I'm trying to look at is what has changed in your life since you first started investing, right? Or better yet, when you first started going into retirement. As you've gotten through retirement and now you're enjoying your time in retirement, how many of you guys agree that things have kind of changed a little bit since you first started in your retirement? Yes? Right? And because of that reason, we need to understand what is the right makeup of your investments that might have shifted from the first time we met. Does that make sense? So please, when we send you out these emails, don't just click them, go to send them to junk or delete them, Linda, right? And get Sherry in trouble, right? What I need you guys to do is really read some of the stuff that we give you, because we're really trying to figure out a better way to make sure we're managing your assets. You can't sit there and say, hey, Cory, we're down 20, 30%, and we've sent out risk analysis trying to tell you how we want to reallocate your positions, but you never respond back to us. Okay? So it's really important to make sure that you look at those emails and those text blasts, because that's what we're needed for. Does that make sense? Perfect. All right.
All right. I think next year for the award ceremony, it's going to be the most responsive to Sherry's emails. And I'm going to have an award for who responds. All right. I'm going to pass the baton now to my colleague, Mr. Antoine Turner, who's going to talk a little bit about the Secure Act 2.0.
Thank you. Hi, everybody. That's pretty ironic. I got on the same tie. That's my... Oh, and the same suit. Different shirt. Hi, everybody. Welcome to the South Bay. My name is Antoine. I, too, use my legs to get here. But my colleague didn't tell you about all the wonderful things here in the South Bay. Just FYI, a couple of things. I've been over here for about 22 years. How many people are familiar with Bruce's Beach? You've heard Bruce's Beach. Right up here on Highland. Might want to drive down, take a look. Bruce's Beach, wonderful place, a lot of great things. Well, let me rephrase that. Check out Bruce's Beach. At the corner here is the 𝗀𝗲𝗄. The 𝗀𝗲𝗄 is a really good breakfast restaurant if you haven't been there, right here on the corner. My wife and I sit out there and gossip about folks that got on two pieces they shouldn't be wearing. But we do that often. The place across from the library, Bill's Pancake House? Yeah, Uncle Bill's Pancake House, also on Highland. Great place down there you want to check out. Slay's Restaurant, great Italian restaurant, a little bit further down across from the 𝗀𝗄𝗄. So, and lastly,
you guys didn't know that Antoine is a tour guide as well on a part-time basis, right?
And finally, Nick's. Nick's is over here in the Manhattan Beach Village over here. Great restaurant, Nick's, kind of a hidden jewel. So, with all that being said, I'm going to share with you a few nuggets related to the Secure Act 2.0. December 29th was a pretty significant date because the Secure Act 2.0 was signed into law, and the ink is now dry on this legislation. In prior to 2019, there were rules as it relates to retirement plans. And there were certain rules, in particular rules centered around required minimum distributions. I'm sure Cory has spoken to many of you about RMDs, or required minimum distributions. Required minimum distributions is a federal rule that says you are required, whether you like it or not, to withdraw monies down from any qualified retirement plans that you hold, that being a 401k, a 457 deferred comp, a 403b, any of those types of plans, you are required prior to 219 to take the required minimum distributions at age 70 and a half, April of the year after you turn 70 and a half. Well, in 2019, the former president changed that. And it's a good thing. He moved it out to age 72. So now you have about 18 months or so more to save money in your qualified retirement plan. Well, on this last year, December 29th, President Biden and this new legislation has now moved it to 73. Okay? And then there will also, I beg your pardon? Uh-oh, everybody's knocking down that H, huh? There will also be, dependent upon your age, where it will index out to 73 ultimately to 75. Now, I want to share something with you that how many, show of hands, well, I already know the answer to this, and how many people think the government and the IRS is a philanthropic organization? Right? It could be. It could be. I have some friends that understand the tax code, and it could be a philanthropic opportunity, and it's buried in the tax code if you know how to use it. And that's one of the things that we do best at EFC that we'll share with you. But my point is, I want you to see what's happening here. So we talked about forecasting. My colleagues talked about forecasting, looking out, right? Cory talks about it, and that's what we do at EFC. We're forecasting and looking out at what's ahead. And believe me, the best planners in the world is the IRS, and they are also forecasting. And here's what they're doing. Now think about this. If you now have the ability to save more money in your retirement account, out to 73, ultimately out to 75, depending upon your age, what happens to your account? Well, it'll grow, right? So now you have a bigger amount in the account. Well, if we're $30 trillion or so in debt, and if you heard Cory mention this, you should hear it again. There is something called a sunset provision. There's a tax code that was taken away when the former president was in office that is now going to be coming back. It's sunsetting. So what does that mean? Well, I have an account that has now grown quite a bit, and now the new tax code comes in. What just happened? I am now possibly in a higher tax bracket when I have to now, when I'm required to take the money out of the account. So it's a double-edged sword here. Yeah, I got more time to save money in the account for it to grow larger, but I'm also in a position where now I could ultimately be in a higher tax bracket, so when I take the money out, I paid more in taxes than I did saving that extra year, 2 or 3. Now think about this as well. This is a good thing. What they did is the required minimum distribution rule says that if you do not take what is required of you to take, it is a 50% penalty plus taxes, and you cannot get around it. Well, guess what? They dropped it down to 25%. Right? And in some cases, it's going to go down to about 10%, right? But again, think about this double-edged sword. If my account has grown significantly to more, although you reduce the penalty to 25%, you're still going to get what you're going to get from me because I'm now in a higher tax bracket. I got more money in the account. So again, it's a double-edged sword, and this is why it's important that we forecast and we sit down and we strategize and prepare for what Uncle Sam is doing here. There's ways to deal with this, and I can tell you from people I know that live across the street and around the corner, they are talking to their advisors to make these moves now because there are strategies that we have at EFC Wealth Management that can help to protect your assets and protect you from what's to come here. And I want to say this as well. If you have friends that have qualified plans that work for an organization that offers a 401k or a 457 or 403b, now is the time to introduce them to us. Now is the time to introduce them to us so we can prepare for this. Okay, so I'll move on to the next one here. And this is creating what we call a bigger catch-up contribution. Typically it's $6,500, $6,500, pardon me, where you're able to now put an extra $6,500 away into a qualified account. So again, if you have girlfriends or someone who is in a 401k, and think about this, this is a great thing, in their organization, for example, I'm going to pull out LA County. They have a 401k where they will match up to 4%. Well, think about this. If I'm at the door of retirement and I can add an additional $6,500 to my account and they're going to match it 4%, I just boosted my account pretty significantly, right? So this is, again, another opportunity to invite a friend of yours. I'm not picking that up. I'm not picking that up. I'm not picking that up. I'm going to keep going here. So again, another opportunity, get that black card in your wallet, in your purse. And yeah, the credit limit on the black card. Wow. So the third point here, broadening uses of unused college savings money. This is another thing that excited me, and here's why. The 529 college plan is a way for you to save for your child or grandchild's education. I've done that. I started that when my son was born. Some money grew in it. And now what's going on is they will now allow you to roll over that 529. Now, typically on a 529 plan, if the monies are not used for college, there could be a 10% penalty on it, and there could be taxes if you pull that money, right? So what they're now doing, and they're saying that this is a windfall for wealthy people, they're now allowing folks to roll over 529 college funds into a Roth IRA. That's a pretty significant opportunity. But there's a catch. I got excited. I called my wife in. I'm like, wow, we can get that money back because we got a nice little lacrosse star who just got a full ride D1 scholarship to a college, and now we can get that money back. Oh, not too fast. Not so fast. So here's what's happening here. What's happening is now you can roll that money over into a Roth IRA for the child. For the child. Okay? And you must have had that 529 for at least 15 years in order to do it. So as you can see, the government is and the IRS is planning ahead. We must plan ahead as well. And we're looking ahead, and we're prepared to help you with every one of these 3 bullet points to protect what you have and to use the tax code as an asset like all the people around here do. We know how to do it. So reach out to us, and we'd be happy to help you out with that and share this information with you. Thank you guys for listening.
Awesome, awesome. I'm going to call Mr. Cory Chapman, the founder, the CEO of EFC Wealth Management. Come on down.
So guys, before I dive into this,
Skip ahead to you.
yeah, I'll skip ahead. First and foremost, is there any questions for either of the speakers that were up here about some of the products they were talking about, some questions you had about some of the commentary that they said? Does anybody in the room have any questions? Yes, John.
Go back to Tim in terms of products. Tim, if you can explain more what your products are. I know that might be longer than
Yeah, thank you. So the question was, what products do I represent? What products does Sterling Capital offer? Well, first of all, thank you for the question. All right. So what we provide, again, is a nice complement to First Trust, and we provide through AE Wealth, one of the partners, a turnkey solution where we will, based on your risk tolerance, do the asset allocation, the mix between stocks and bonds, the overweights to underweights that I had talked about before, and then all the different asset classes, not just stocks and bonds, but domestic, international, large, mid, small, value, growth, so on and so forth, where we can be a core of what a solution is for your retirement or whatever your goals are, and then working with Cory to make sure we're maximizing the dollars in the most cost-efficient way possible. But I always love giving a commercial, so thank you very much.
So let me kind of add to that, okay? So many of you guys have your investment portfolios, and you'll see names like diversified income, or you'll see things that we use that have something along the lines of your platform that basically is the allocation of your investments. So what Tim's company does, those are the people that we use to build your portfolios out. Does that make sense to everybody? Okay? And so the focus here is really, when I bring them out, is I'm looking for places that have lower volatility, right? Because volatility is not necessarily a great thing at times, but sometimes it can be a little overwhelming when you see your accounts moving up and down quite a bit. So one of the things we love about Sterling Capital is that they reduce a lot of their volatility in a lot of their portfolios. So when I start to create the models that we want for our plans, our focus is really centered around who can we bring into our platform that gives us decent rates of returns, but also reduces the volatility so you guys are not seeing a lot of ups and downs. Make sense? Okay? And so that's where Sterling comes into play for us. You guys see on your statement it says AE Wealth Management on there, right? So AE Wealth is our sister company or our partner to our third-party managers. So while I'm here in the office and I'm talking to you guys about the sound fiscal house strategy, I have to partner with a group, it's not the H, I have to partner with groups of investment advisors and third-party managers who can facilitate our recommendations as far as your investments. Make sense? That way I can sit down and have conversation with you about planning and strategies and things along that nature. But I can't do that if I'm constantly looking at your markets and wondering what to move around and how to move it. So instead, we bring on gentlemen like these two here and say, here are the models that we want to put into your portfolios, and their third-party managers help us manage the process. Make sense? So that's how the correlation and the relation works. Good. Any other questions? Yes. Let me grab a mic for you way back there.
I kind of have a general question. Regarding the U.S. Debt limit, if in case the U.S. government has to default on each debt, does that affect any of our portfolio in any way, any shape or form?
That would be suboptimal. Yeah, so again, the question is debt limit, it's in the news. Would a default cause, what kind of implications would a default cause on portfolios? None of them positive. We firmly believe that there will be a debt limit increase. There's been a debt limit increase every time that there's been a debt limit issue. I guess the frustration that we're dealing with right now is that there is a new Congress. This new Congress is going to bow up a little bit and try to tell their constituents that they are fiscally responsible and they aren't going to do this. Eventually, there's going to be some smoke-filled room deals, and the debt limit will eventually get raised, because I couldn't help but notice that $1.7 trillion deal that was just done, what, a month or two ago? Both sides signed off on it, so it seems like both sides should be able to pay for it.
Yeah, perfect. Go ahead.
Yeah,
It's on.
yeah, just a simple questions.
Lift it up to your face.
I like these. Oh, I thought I did. Oh, okay. Yeah, you talked about the good analysis of 2022. Then you talked about the 60-40, right? And my concern is, I'm retired. My son is here. I want him to learn from my mistakes. So what's the future if we're going to discount 60-40 as a way to put your package together? What's coming up in the future?
I got a mic. So, good question. So, what George is basically saying is that where he's at in his life, in his time, his age demographic, his outcome or his objectives in his life are going to be completely different than maybe what his son is, right? Because he's in a different age bracket. Does everybody follow me so far? How many guys agree that when you first started in investing, maybe at your job, you were working there 20, 30, 40 years, you were putting money into your 401k plan. Were your outlook on the world a little bit different back then when you were in your 20s and 30s? Yes or yes? Yep. Right? Okay. And as time went on, things changed, yes? Yep. Now you got closer towards a time where it was retirement time. And as you got ready for retirement, you started looking at things differently, right? We started thinking about things like income, how important that might be when I leave my job and there's no longer a paycheck. That's important. We started thinking about safety. Well, I don't want to lose any money because there's not much more to make up once I leave my job, right? And we started thinking about one last thing called taxes. Everybody loves taxes, right? So our thought process starts to change drastically as we get older. And so when we were talking about the 60-40 split, so there are different models that you can go into based off of what your risk tolerances are, your time horizon, and then more importantly, what your objectives are. And the more that you are in the equity markets, say stocks or ETFs, mutual funds, things of that nature, our focus then is really about looking for growth. Does that make sense to everybody? So if we're looking for growth, we're hoping that the market is going to go where? Up, right? So we're looking for the market to go up because we're focusing on our growth. Then we need to have more equities in that part of your portfolio. But as time goes on and you're feeling that you're getting closer to retirement and you're thinking at the same time you want to take less risk involved, right? Then the first thing you start to think about is maybe what we like to call bonds, right? And bonds ultimately are supposed to be the opposite of equities. That means that if you're going into the equity market, you want to take a little bit more risk, but you usually will buy bonds to offset the risk and buy something that's going to be a little bit more conservative. Now, the crazy part is, if anybody had bonds this last year or so, did anybody go, oh my God, what just happened? Yes, right? Because the bond market was almost just as bad as the equity market. So then the first thing the clients say, well, if I can't go to bonds for safety, and I can't go to equity because they're bad, what do we do? Right? Because everything we look at is going up, is going down, and there's no safe haven. So to answer your question, each person's specific objective is always going to be different, right? Because there's no one size fits all. Hence why when you come into our office, the very first thing we do with you is sit down and create a retirement analysis, right? The focus is asking what is important to you when it comes to planning. What are your retirement outcomes look like? What are your time horizons look like? How well have you saved? How much money do you have in your bank account? Are we thinking about putting kids through college? Are they already out of the house? All these questions come into play because your specific outcome is going to be determined by those questions that you answer. Does everybody get that? Okay? So when George asked the question, hey, we understand that 60-40 is not a good mix right now because we hear it's terrible. What is the right mix? The answer is it depends on where you're at in your life, your age, your time horizon, and what you're ultimately trying to accomplish. See, here's the difference. We have about 60, 70 people in the room right now, and everyone in here has a different outlook on your retirement. Some people, when they think of retirement, they want to do nothing more but hang out with their grandkids. Yes? Some people say, I don't want to see my dang grandkids, okay? Keep them out of my house. They mess up everything they come in, right? Some of you guys in here love to travel, and you want to travel first class. Go on the best cruise possible. Go to some of the amazing islands that you've always wanted to go to, right? But some of you want to get in an RV truck and drive cross country. That wouldn't be me, but I'm going to tell you, that's fine, okay? My idea of camping is glamping, okay? I need 4 seasons on one side, okay? But ultimately, guys, we all have our different outlooks on what the retirement should look like. Now, I get this question all the time, Cory, how do we refer people to you? And the first thing they always do is they go, I have a son or daughter that we should come and talk to you. Well, our primary focus is really retirees. Does that make sense? So that means that what we focus on so that we can be really good at this is people who are over the age of 50, right? Because it is a different outlook for someone who's in their 20s compared to somebody in their 50s. Does that make sense? Now, as a firm, and because you guys are part of our family, we will definitely take your children on and help them, okay? But our focus is really retirees. That's what we're good at. We know about tax planning. If anybody's ever had an advisor in the past, and you talk to your advisor about taxes, the first thing they tell you to do is go see who? The CPA. Exactly, right? You come to us without taxes, like, yeah, bring them, let's go, let's have a conversation. Because that's what we specialize in. Does that make sense to everybody? So our planning process is around people who are just like you, people who are in retirement mode. We spend a lot of our energy and time learning the tax code, learning the best ways to mitigate your taxes so you can be more efficient. Because here's what they didn't tell you. How many guys did work at their current job for at least 30 years when you retired? Let's see a show of hands. Be proud. Perfect. Good. Along that way, with that same question, how many guys raise your hand, how many were you putting money away into your retirement plan? 401k plan, 403b, 457 plan? Let me see a show of hands. Perfect, about the same people. Now, someone sold you this myth. They said, guys, put money into your qualified plan. And you do so because sometime in the future, when you get older, you're going to be in what? A lower? Let's say that a little louder. You guys going to be in a lower? Tax bracket. So you guys sold those goods and services, right? Someone told you this, you believed it, you thought this was the best thing since sliced bread. Then all of a sudden, you're 30 years later, and you're getting ready to retire. And the first question I always ask you guys is this. How many of you guys want to live in a lower tax bracket? Does anybody want to live on less? Does anybody want to cut out coupons and live a little harder than things are right now? I have been in this for 26 years, and I don't think anybody has ever told me, Cory, I'd like to have less when I'm in retirement. No one. Right? Yeah, cutting coupons out, right? So here's what I've learned. Although that's the myth that you would be in a tax bracket that must be lower or might be lower, it typically doesn't happen if you've done a great job at planning, right? Because here's your age demographics right now, the majority of you had a pension plan of some type. And that pension plan was almost the same amount of income you were getting when you left, or maybe even more in some areas, right? So now you got pension income coming in. Then you got Social Security income coming in. And then what about all that savings that you put away into your retirement? Then you got that money coming too. And oh, by the way, as Antoine just said, IRS says, hey, this is your silent partner talking. Don't forget me, I want mine too, because you never paid us our part, right? And all of a sudden you look up and the IRS is saying, well, we're going to force you to start taking this thing called RMDs. That means that you can defer it as long as you want, up to an age, right? But when that age comes up, we want our piece, because we don't want you dying without us getting ours. That's pretty much what it is, right? That's really what it is. So if that's the case, we have to think about a better way to plan. Would you guys agree with that? See, here's what I like, and Antoine said this earlier. He said that it sounds like a good deal with that 2.0 version of the Secure Act. We're going to allow you to just defer longer. And for those who are not informed, you're like, this sounds good. Let's just wait a little longer to take it out. We don't have to do it right away. Let's keep it out as long as we have to, right? Let it stay as long as it can. Well, like Antoine said, that money is sitting in the account. And if you got a good advisor, and the markets are doing better, the account should grow, right? But when you get ready to start take that money out, because the account has grown, what happens now? Your tax bracket is going to grow as well, right? And now when we start to take that income out, we're paying more in taxes. You guys understand this? They're not doing you a favor, they're doing themselves a favor. Because if the partnership is, I'm silent right now, but at some point in time, they're going to be like, hey, give me mine. And you have more money now, so that means you're paying more in taxes. Everybody follow me on that? Yeah. So what are we supposed to be doing? We're supposed to be thinking about how do we get better at our process? How do we think this through and come up with a better ideal so that we don't ultimately spend more money? And more importantly, we get to keep more of our assets, more of our money in our pocket. Everybody follow me on that? Yeah. Perfect, I see you. So here's what I want you guys to think about. As we start planning this distribution stage, understand this. Accumulation was when you were making the money and you're saving it. Now it's about the distribution part, right? This is where you're now saying, I have to take this money out at some point because I have to, because the IRS is telling me I have to, my silent partner. But is there a better way to do so? Now, how many of you guys have heard us talk about our sound fiscal house in our office? How many of you guys remember that? Perfect. Every hand in this room better be raised, okay? The sound fiscal house, all right? So, this is our strategy we talk about all the time, which is the roof, the walls, the foundation, the fence. Now that sound a little familiar? Everybody go, oh, got it, all right. So, one of the things that we talk a lot about is how to strategically plan when it comes to our distribution. How do we move money from the tax-deferred bucket to the tax-free bucket? How many of you guys agree that free is better than paying something? Yes? So the focus right now it should be when we start to strategize and take money out of our tax-deferred account, we want to do it in a way that we can control our tax liability. Now, Antoine said something earlier, and he talked about, he stole my thunder because this is in my slide, but I'm just going to tell him now, okay? So we talked about this thing called the sunset provision, right? And what it basically says is that come 2026, we're going to revert back to what the tax bracket codes were in 2017. Now, what changed when Donald Trump got into office, every time I say that, I feel like it's going to be a political thing. But when Donald Trump got into the office, one of the things that we realized he made one significant change was helping us with the tax code, right? We actually lowered some of the tax brackets, which gave us a little bit better outcome as far as cash is concerned and money that you take out. But here's what happens. Come 2026, those rates that are lower now are going to revert back to where they were in 2017. Now, here's the problem with that. How many guys agree that taxes are probably going to go up in the future? See, show of hands. I agree, and I'll tell you why. We're, at about $30 trillion in debt right now. You guys understand? $30 trillion in debt. Now, every time we had a stimulus package that just came out during COVID, where did that money come from? We just magically printed it, right? We went to the basement, put on a dang copier that could copy money, and just handed it out like it was nothing, right? Here we go. Someone will figure it out down the road. And that's what we did. Now our national debt is probably higher than it's ever been. And because of that reason, the only way we can actually start to get that debt to come down is in the form of what? Taxes. Everybody follow me on that? If you don't understand anything else, you must understand this. When it comes to tax planning, you got to get the basics down, guys. Because this is what's going to help you last through retirement. See, what I always tell clients is one thing to get to retirement, it's a whole other thing to get through retirement. Everybody agree with that? Yeah. Okay? So here's what I want you to get out of this. As we start thinking this process through, we want to take money out the most efficient way possible. We want to make sure at the end of the day our focus is about reducing our tax liability so we can keep more money in our pocket. But do it in a way that becomes efficient to you. Everybody follow me so far? Yeah. This is what our plan and our focus is at EFC is all about, that sound fiscal house. So we do this on an annual basis, and we need to review your accounts annually. I can't begin to tell you how many times we send emails out, text messages out. Heck, we're on voice broadcast now, okay? And still, I didn't get my appointment set, and I didn't get my review done. Guys, you got to play the game with us. We have to be a team, right? I can only help you in the process if you call me back. I'm not mentioning nobody. If you call me back so that we can work through the process together, right? Ta-da, right? So, I want to make sure everybody understands this, okay? The way we can do our job better is that we have to communicate. Is that fair? Yeah. We have to be a team. We are co-creating your retirement. This is not a short-term thing. This is long-term. You guys can get tired of looking at me for 30 years, okay? But that's where we're at. But the only way that we can make sure your plan is working is if we communicate. If we sit down annually, let me say that one more time. Annually, not every 3 to 5 years, right? Annually. Listen, I love that all of you, at least the majority of you in this room, and I love this all the time. Hey, why do I need to come to the event? Cory's got a handle. I appreciate that. But I still need your input. Does that make sense to everybody? I love that you trust us. You always have faith. What happens, heaven forbid, let me knock on some wood. Okay. If I got hit by a car, someone in my office has got to understand what your goals and your objectives are. You understand? We have a lot of interaction, especially in my black club. We talk quite a bit, and I know a lot about what's going on. But my team has got to know it as well, right? They got to understand what's happening so they can help you reach the goals that you want to have, not only today, but also in the future. Make sense? Yes. Perfect. I want to drive into one thing on this slide. I want to kind of fast forward to it because I think this is important for you guys to get this. I know you guys can't see it because it's in green, but I need you guys to understand about understanding these markets, okay? So it says, what is a correction? I get the call sometimes, and not many of you, but I get the call sometimes. It says, Cory, oh my God, these markets are crazy. We're losing so much money. Get me out of this market. I'm so worried. I'm only down 5%, but God, there's a lot of money to me, okay? I'm not mentioning no names, right? But understand, here's what I need you to understand. A pullback is 5 to 9%, okay? You heard Tim say earlier that typically after we come back from a bear market that typically is 20% loss, we shoot through the roof after that. If you look at the historical trend of all the markets that have been, we've had bad times, those black swan events. But then we take off, and it goes for a long period of time. Does everybody get that? This is what I need you guys to understand. Don't panic, all right? If I call you, then it's time to panic, okay? That's a whole different story, okay? Because if I haven't called you and said, hey, don't worry about it, the market's fine, you got to remember a couple of things. When we sat down and started talking about your retirement plan, the very first thing I said to you is that we have to put things in different buckets. You guys remember that? Yeah. Different parts of your house. The roof, the walls, the foundation, the fence. The primary focus was that anything that was in the roof was supposed to be at what? Risk. Thank you. Okay? Let me say that again for those who don't remember this, okay? The roof section of the house, you see this over here, right? That's where all the investment side comes from. These are your stocks, your bonds, your mutual funds, your ETFs, things that are designed to go up or down. Everybody follow me on that? Yeah. That's what we have in that bucket. Now, if we plan properly, do I ever put 100% of your investments in the roof? No. That should be more resounding. Do I put 100% of your money in the roof? No. Thank you. That's what I'm looking for. So know that if we don't have 100% of your money in the roof, I did it specifically because there's a percentage of that money that we want to be at risk so that it can get us some sort of growth, some sort of rate of return. Does everybody understand that? Everybody in the room needs some sort of risk. The object is to figure out how much risk do we need. And that's where our sit-downs come into play. Now, you may have had more money at risk when we first started, and you may now back off a little bit because maybe now you're a little bit more conservative. Maybe you don't want to spend as much money in the markets as you have to. So those things happen, but that's when we make our conversations and our reviews on an annual basis so we can adjust accordingly. Does everybody follow me on that? The second part that we talk all the way about is the walls. The walls generate what for me, guys? Anybody remember? Income. The walls generate income. So I have money in certain portions of your account so that it pays you an income stream. How many guys agree when you're in retirement, income's probably important? Yes, yes. It is, guys. Having some sort of income coming in is extremely important, especially if your income sources are less than your normal money coming in from your pension and your Social Security, and maybe your expenses are exceeding that. We need to make sure there's money coming from other sources to cover that cost. Does that make sense to everybody? Yep. Perfect. The third thing we talk about, which is where everybody's focus is usually at, is the foundation, right? This is that safe money. Everybody get that? This is that safe money. The money that we're going to put into that account is designed for one thing and one thing only, to be there in case something goes wrong. See, I'm on camera. If shit happens, this is that fund that we fall back to. Does everybody understand? Because that's what it's there for. It's designed not to lose any money, but at the same time, we can always get to it if we have to. Does everybody understand? Okay? And then last but not least, the fence. And the fence talks a lot about, you know I can't read that, right? Okay. Oh, got it, yeah. So what I was saying was, the fence talks about tax strategies, right? And safety of principle. How many of you guys in this room right now live in California? All of us. How many of us have real estate property and we live in California? A big chunk of us, right? Here's the thing. We have something called probate in California. This basically says that if you die without some sort of explanation of who you want your property to go to, it could go through probate. Does anybody follow me on that? All probate is that we're going to have the court system come in and deem where our assets should go because no one told them what to do with it. Everybody get that? Yes. Whose fault is that if that happens? Well. Yours. Everybody follow me on that? If you have real property and you live in California and you do not have a living trust, you are killing yourself. Trust me. You will have these assets go somewhere that you don't want them to go to, and almost 55% of that comes out in probate. That's a lot of money to give up to the state that you don't want to give up. Okay? So, when we talk about the fence, we're talking about protection, living trust, estate planning, looking at it from the bigger scheme of things to make sure you guys have all these taken care of. If you've gone through the first 4 stages of our Sound Fiscal House and you didn't create your trust, please talk to us about that. Thank you. Please talk to us about that so that way we can help you get that taken care of. It is important to us to make sure all of your assets are protected. Not this one. So, Can anybody agree that when you look at your investments, that when you look at them, it's a different point in time of your life? Does that make sense to everybody? Yeah. And what I want you guys to get out of this is if you go back to 2008, how many guys were in the markets in 2008? Let me see your hands. Was it scary? Yep. Probably the worst thing you've ever felt in that time in the markets, right? Down 37, 40%, somewhere there about, right? Yeah. But what's interesting is that if you look at, and I apologize, I don't have it up here, but if it's kind of the same concept, is if you look back at 2008, over in this area here, right, over here, that's kind of where we were looking back at 2008. And then over time, we started to increase and go up. But what was interesting about this conversation was it didn't go straight up. It had ebbs and flows. But over time, it kept getting bigger and bigger. And what was interesting is if you look at the snapshot from the last 2 years, and all you looked at was these last 2 years, and you look at your portfolio, you're going, holy cow, I'm losing money, right? And then you're panicking because your overall thought is I've lost money. When 2008 happened, do you guys understand, anybody heard the term the lost decade? Because what they were saying was that we gave up 10 years worth of asset or growth in that time frame. Does anybody get that? 10 years. We had a drop back in 2020 when the pandemic happened in March, and we went down about 30-something%. But then all of a sudden, we shot back up. And then we've just kind of ebbed and flowed since then. But if you look at the graph of the S&P 500, everybody go home tonight, go on Google and type in S&P 500 20-year graph. It'll show you how much has grown over that time period. And unfortunately, what we have a problem doing is we have our micro view on. We're looking at the small term picture right now and not looking at the macro picture. Do I understand? And that's where we get caught up in that emotional euphoria, I like to call it, right? And we're worried and we're panicking and we're going through that process. You have to realize that, again, the way we've structured your accounts, there's only a portion of your money that's in the market, and we've allocated how much that should be based off our conversation. So what our job is now is to ride it out and keep letting it do what it's supposed to do. Everybody follow me on that? This is not run, jump, get in, get out, get in, get out. Timing the market is the worst thing we could ever do. I need you guys to understand it. You have to be right twice, going in and coming out. That's not necessarily going to happen. Yes, Wendy?
In hoping and expecting the market to recover at some point, is it contingent more on where your investments are? Like, say, if some investments are more like, say, in Asian markets than domestic markets, sure, or European markets, is that going to, do you think that is going to affect it, or because
sure,
I'm hearing that some might recover more so than others.
Sure.
And so is there a different strategy for people who have investments that are more in one kind of market than another, or? And you know I'm new to all this, Cory, so.
No worries.
So.
Good. So to kind of answer that question is simply this. Yes, there are always going to be different sectors of the market that are going to do better than others, okay? But your job is not to necessarily try to go figure that out for us. That's what we do. Does that make sense? As we start to look at your accounts and we start looking at what's performing, what's not performing, what's doing bad, what's doing good, what are we hearing on the markets, and when we're talking to different analysts and different money managers and things of that nature, that's what our job is, right? To figure out the right mix that you should have in your portfolio. Does everybody follow me on that? Okay? So when you see, again, when you see this email that comes out to you, and I say, hey guys, we're thinking about doing some allocation changes. We want to get you to give us a call and fill out this risk-alize form. It's so important to get that back to us, because that helps us figure out how we need to re-blend your markets, right? Reallocate the assets to kind of keep pace with what's going on in the markets. Does that make sense? All right? Look, we employ a lot of smart people, right? And their job is nothing more than to try to figure out what's going on in this market. That's it, guys. This is all they do all day, day in, day out. And we're fortunate enough to have a lot of institutional managers that we have access to. And that's not because of anything other than the fact that we built a great relationship with a lot of these places. So leverage our experience and our insight to make that happen for you. But again, gotta keep going back to, we've got to communicate, and we have to hear from you, okay? I'm not pointing out anybody, okay, anything like that. So. You know what I'm saying?
Can't we just, communicate once and Cory, take it and run with it?
Yeah, see? So listen, I love that you guys trust me enough to let me do that. I do, I really do. But here's where the challenge comes in sometimes, right? Sometimes I don't know what might have changed in your life while in retirement. Does everybody get that? Because sometimes when you started retirement, things were a certain way, and I do have some clients that go out and buy brand new sports cars and things of that nature, right, that may change up how much money is in their accounts. And we may have allocated money for a longer period of time that because we were doing fast spending, traveling more, buying things, spending more than we should have, maybe buying more apartments or maybe some houses, stuff like that, those assets that we thought were going to last us longer may not last us as long because we've been doing that. Does that make sense? Because remember when you first come into our office, we come up with your plan and say, hey, based on what we have here, we got you to age 100. Life looks good. But that didn't mean you just bought 2 sports cars, a new house down in Florida, got the boat on the pier now. See, none of that was in the equation when we first started the conversation. So understand, when those changes happen, what do we got to do? We have to adjust them. We have to figure out if it's still going to work. We got to figure out what we got to do differently to keep you in retirement. So yes, you can say, hey, Cory, have at it, run with it. Thank you. We trust you. Go. But there are some times when things happen that we need to know about. We need to be able to talk about that and strategize. Here's the other thing, right? And this is what I want you guys to get. It's okay to want to have a lot of cash sitting in the bank because it helps you feel safe, right? I get that. I do. It's funny because at one point in time, my wife had to remind me of that, right? And I said, well, it's here. I need to see it, okay? And so I'm guilty of it as well. But then here's what I realized again. All that cash that's sitting there, quite honestly, is earning you little to nothing. And the bad part about it is that while it's sitting there, we want it to grow as much as we can so we can generate better returns. That's where our income comes from, right? And this is what we're not doing more of, and we need to do more of that. But the second part that I want to really kind of talk about is that when you're taking distributions from your investments and you have a boatload of money sitting in your savings account, why would you keep taking the distribution from your investments? You guys follow me? Because what does that distribution do to you? It puts you into a higher bracket. Because every time you take that money out of your retirement plan, there becomes more income. And so as you keep doing that, and you already have 6 months worth of reserve, 3 months worth of reserve in your bank account, and you're still taking $3,000, $4,000 a month from your retirement account, you're adding yourself into a higher bracket. And now you're paying more taxes. That doesn't make sense, guys, right? We have to start thinking about this from an economic standpoint if you want to last through retirement. The more money you take out, it doesn't do you any good to take it out and just put it back into a savings account. One, the yield is the lowest possible. It doesn't keep pace with inflation. Inflation last year, almost 7.5%, almost 9%. Are any of you guys earning 9% in your savings accounts right now? If so, tell me so I can move some of my money there. Seriously. So if that's the case, why would you keep so much cash in your savings account? And then continue to keep taking distributions from your investments? It doesn't make sense. Remember, our game here is we're trying to beat the IRS, right? We're trying to figure out how do we keep more of our money in our pocket, reduce our tax liabilities as much as we can, and live comfortably in our lifestyle. That's where we're supposed to be at. Everybody follow me on this? Okay? I know I got on a tangent, but bear with me. All I want to kind of basically say from that standpoint is that when it comes to risk, we have a software that's called 𝐒𝐿𝐼𝐍𝐃. And what we do is we can go up to a 95% probability figuring out how much risk your portfolio will have. So when Wendy was saying to me, Cory, what do I do about the markets? Do I need to change or do something different on my investments? Or should I be looking at different types of sectors I should be investing in? This is how we do it. We give you what's called a 𝗏𝐿𝐼𝐍𝗃 score, and based on that risk score, it's going to help us develop what type of portfolio is going to be the best fit for you. Does everybody follow me on that? And what's great about it is that it comes in between a 95% probability that we're going to be spot on the 6-month time frame. Pretty cool? See, we spend a lot of time trying to analyze and figure out the best way to work with our clients. And what we've done is take this to make sure we can do just that. So what I want you guys all to understand is everyone in here should be updating this annually. Because that risk score tells us what type of allocation we should have you invested in. Does that make sense? And this is how we're going to make sure we get you guys through retirement and make sure you don't run out of time in retirement. Okay? Let's talk a little bit about this tax shift. And we kind of just talked a lot about it right now. The two things that I always talk about is micro and macro views of your taxes. Tax diversification is just as important as investment diversification. You guys understand what that means? So everybody knows there is a taxable bucket, right? Money that you put in your savings checking account, every time you earn something, you pay what? Taxes. Some sort of interest grows, and when you do that, you get this nice little love letter. Sherry, can you give me some more water, please? You get this nice little love letter from the IRS called a 1099, right? They're letting you know that over that time period, for whatever reason, you earned some interest, and because you've earned that interest, Uncle Sam wants his piece of the pie, right? So again, savings checking account, money sits in that account, growing at a lower rate of return, lower than inflation, why put the money there? The next bucket we're going to talk about is tax deferred. We just discussed that. The myth of the family talks about putting money into tax deferred vehicles so that sometime in the future you take it out. But unfortunately, we all know that taxes are probably going up in the future. So why would I put money in tax deferred vehicles? The third thing that we go into the tax bucket is called a tax-free bucket. I always get the question, how much do we have in there? AMAP, as much as possible, right? That's our focus point. Get as much of our money moved into the tax-free bucket as we possibly can. Thank you. By doing that, it gives us more choices. Everybody follow me? Or as of right now, our Roth IRAs, do you have to do RMDs on Roth IRAs? No. So that means once I pay the tax, every dollar that grows in that account, guess what? I don't pay any more taxes on it. It all gets to grow in that account. The great thing about that is now you have some great growth and same types of investments you can go into without having to worry about paying Uncle Sam down the road because it keeps growing. So we like tax-free buckets. The other thing we like on top of Roth accounts are specially structured life insurance. Now, as soon as I said life insurance, everybody got quiet. Let's talk about life insurance for 1 second. It used to be back in the day that all you thought about when it came to life insurance was death. I'm buying life insurance for someone to be happy with the money they got from me when I died. Right? Let's be fair, right? What I love about life insurance, there are parts of the IRS code that we get to take advantage of and we can allow that money to grow tax-free on all distributions by using life insurance. We call it our life insurance retirement plan, called the LIRP. If you're interested in learning more about it, many of you guys have that already with this. But it's a great way to let money grow tax-free and protect your family at the same time. Oh, by the way, we can add in something called a long-term care rider. How many guys think that they might have some kind of illnesses as you get older? Probably. Maybe. I know I'm feeling it already. These days I get out of the bed. You know, it's so funny. My mom's here. I used to watch my mom when she'd get up in the morning and she used to rub her knees. And I never understood what that meant until when I turned 52, I was like, man, what is this? So I totally understand what that means now, okay? Your body changes when you get a little older, all right? Yes. So macro view, when it comes to taxation. When you have the micro view, how many of you guys go to CPAs? So a CPA typically tells you what happened last year in the arrears, right? And then how much you owe now. That sound about right? Yep. The macro view, the bigger picture, is what we do. We're not tax planners. We're not tax preparation. We do tax planning. Well, here's what you've done this year. How do we reduce that tax liability in the future? Everybody follow me? So if I said, okay, your RMD is at X, how much money can we take out this year to reduce your tax liability for the next years to come? Now, here's the part that I always have a hard time with, or a lot of my clients have a hard time with. Cory, you want me to pay taxes now? Like right now? I don't have to pay them. You still want me to pay them? Yeah, I want you to pay them. Because here's the part we're missing. Although we're paying this tax here, that may be this much right now, over time gets bigger. Everybody follow me? Yeah. So, did I just say taxes were on sale right now? You guys remember me talking about that? Things are lower than they've been in a very long time, up until 2026. And because of that reason, when would be the best time to start paying things that you have to pay tax on? Now. Guys get me? Now. Not 2 years, 3 years, 5 years from now. Now. Because there are lower brackets. And those lower brackets gives us the ability to pay that tax in a lower bracket, so that way we can move it to something that's tax-free, and then we don't pay any more tax on it. That's the logic behind it. Everybody follow me? That's the macro view when it comes to taxes. And that's what we all should be thinking about. Sounds good? Well, Sherry keeps giving me the sign, keeps saying, get off, get off, get off. So I'm going to wrap with just that. But I want you guys to understand this. Our job at the firm is primarily one thing, to make sure you have a happy retirement. You guys get that? That's our focus. Have a happy retirement. Make sure you can enjoy and do the things that you want to do while you're in retirement. And the only way we can do that is we co-create this process together, which means we have to do our part, but you also have to do your part, right? Thank you for trusting in us. We appreciate it, but please call us when we call you, all right? You guys have a blessed one. Any questions before I pass it over to Sherry? Yes?
Hey, thanks, Cory, for everything here today. Really appreciate it. I did have one question. You touched on the idea of insurance, life insurance in particular. That's something I've been struggling with for a while in terms of how best to sort of have that structured.
Yep.
So I don't know if any of the other folks, or if you could maybe just spend a few more minutes just giving us some ideas of where we should be looking and how we should be structuring our life insurance.
Sure. So for those of you guys who didn't know, we are a full service financial firm, which means we offer everything from stocks, bonds, mutual funds, to life insurance, to long-term care insurance. We help you with your Medicare planning and your Social Security planning and life insurance, okay? So for all intents and purposes, when it comes to looking at life insurance, that's what we're here for, okay? Our goal is to be able to shop around whoever has the best products out there. We're licensed with Prudential, North American, I mean, every company out there you could think of, we probably have a relationship with them, okay? And what we do is go out and try to figure out what the best type of insurance is for you that's out there. And what we'll first do is ask questions to find out what type of insurance you need, and more importantly, what do you actually want, okay? And once we do that, we'll come up with an analysis and run scenarios based off your age and time horizon and what we're using the insurance for. Some people use insurance for tax purposes. Some people use it for death benefits. So that is going to determine what type of plan we put together for you once we figure that out. So set an appointment, come into the office, let us run some numbers. If you already have insurance, you want to kind of see if your policy's doing well or doing bad or good or indifferent, bring it to us. We can run an analysis against you and tell you if it's doing okay. And if it is, we'll tell you keep it up. Don't use it. Don't get rid of it. But if there's something that's kind of outdated, maybe it doesn't have some of the same bells and whistles that this one does now, then we'll tell you that as well. Okay? Patrick, that will help? Cool. Anybody else? Perfect. Before we all leave, just so I don't forget, because I see people are already leaving. Yes. Hold on a second. Before you leave, these are gifts for every family member that we have here. So all of our clients, please make sure you get your gift from us, okay, up here.
It has your
for
name on
They
it.
have your names on it. So as we get ready to wrap up with Sherry, we'll make sure we get these out to you guys. Lila, can you, Alicia, and Melissa come and start grabbing them and kind of take them out to them? Okay. Yes.
Hi. I'm like ultra ignorant about anything with regard to investments and stuff.
Yes, ma'am.
And what would you recommend that I read or study so that when I talk to you or Sherry or Antoine or anybody, that I can come from a place of at least some knowledge and not total
Good question.
ignorance?
Very good question. So that's going to lead right into our conversation that Sherry's going to bring up. And she's going to talk to you about some resources that we're launching for all of our clients. Our goal really is to educate you guys as much as possible. So we have some things that we're getting ready to launch that we think would be helpful for you guys. The other thing I would say, listen, we live in an informational age right now. You can find pretty much anything on YouTube, okay? And I love looking at YouTube because there's so many great ways of displaying the information. Some people need to visually see it, like in a video format. Some people like to read it and just go through it and read it that way. Some people needed to go both ways, right? So the great thing about YouTube, it does give you that opportunity to figure out what the modem or modality is that you're more comfortable with. So I like that. But Sherry's going to talk to you about some of our educational platforms that we're going to be doing.
Great. Skip through that. Okay, great. So I just want to reiterate a couple of things so you guys are aware, because you have this next year, and we want to encourage you to become a part of our Elite Ambassador Club, and if you have the assets, potentially the Black Club. And so I want to just, highlight that. That is, again, referring friends, family. It's not required that they become a client, but at least that they have that first meeting with us, and we have an opportunity to tell them about EFC and tell them about the great things that we have to offer. And so there are perks that come with that. My Elite Ambassadors, we've got a card coming for you, a specially designed card. And again, this is a thing that you re-qualify for every year, right? And so again, when you guys help us, when you help spread the word and tell somebody about us, it means that that's less physical dollars that have to go into marketing, and it helps us build our firm in a more cost-effective way, and we appreciate that. It's why we are loving on you guys. I know we're having fun and we're joking, but it really does make a difference, and we just really, really appreciate you and appreciate that you believe in us enough to tell somebody about us and to encourage them to set that first meeting. Who do I refer? So just, again, really someone like you. If you're a part of our firm, that means that you're a good fit, and that means that you probably hang around other people that are good fits. So you want to find someone that might be a retiree or someone who is soon planning to retire. Maybe someone who is needs a second opinion on what they're doing financially, and they want someone to give them good information. They can come to us and get good information that's not biased to tell them to come be a client, but just give them a good second opinion on what it is that they're doing. Or someone who's maybe experiencing a life event, loss of a spouse, change of job, and inheritance. And just one caveat, we want to make sure the person is 50 years or older. If you are a part of the EFC family and you have children, definitely we're going to take your children, but if you're looking at someone to refer that's not your child, then we want you to encourage you someone that's 50 years of age or older. A couple of perks. So nothing makes us happier than having a positive impact on our community. And so every time one of your referrals meets with an advisor on our team for an initial consultation, we are actually going to make a donation in your honor to one of our chosen charities. And so the charities that we are using this year are Folds of Honor, St. Jude's Children's Research Hospital, the Rooks 𝗀𝘃𝗲 Entrepreneurial Institute, the Wounded Warrior Project, and the NAACP. And so as you refer friends and they come in for their meetings, I'll be the person that'll be sending you a notification, hey, we made a donation in your honor. So you're doing good while you're also doing good. Yes. I used to be a rapper in my past life. So let's talk about how do I refer, because it really is easier than you think. Events like this are simple, and we've got plenty that are coming up. We have several events that are happening over the course of the next week, but The next social kind of event that we're doing is in our office February 7th, and that's our Valentine's event. This is after work. Come in. We'll have a little something for you to nosh on. It won't be dinner. Think snacks. But come and celebrate Valentine's Day with us, and that's on a Tuesday, February 7th. So that's the kind of event that you can bring someone to. It's fun. It's not, full court press, but it's a way for them to meet us. There can also be virtual introductions where it's simply, hey, Sherry, here's someone that I know that would be a great client for EFC. Susie meet Sherry, Sherry meet Susie, and put the email together and send it off. The other thing is that you can call us and we'll actually plan a private dinner with you. If you think this is someone, we'll take them to dinner, and you and the person that you refer, and Cory or one of our other team members will actually go to dinner or go to lunch with them, and we can plan that with you. Really, 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 really simple, very, very easy to accomplish. So I want to talk, any questions on that? Got it. Okay, clear as mud. I know y'all been sitting for a long time, but hang in there. So upcoming events. So we have a lot of great stuff that's happening. So as you know, we have our regular dinner seminars. That's another way that you can refer someone. You can reach out and say, hey, Sherry, what dinner seminar do you guys have this month? And, I want to add someone to the list, to the RSVP list. That's perfect. The other thing that we have, and we are launching, and I'm really excited about it, this is our nonprofit, and it is the Los Angeles Adult Financial Education. And so we are hosting this on the Pepperdine University campus in West Los Angeles. These are workshops, and our first one is called Retirement Readiness, and it's actually happening this Wednesday night from 6 to 9 p.m. And so we're going to be talking about retirement readiness and getting and preparing for that. Cory, you want to say something about Laffy?
Yeah, so Laffy is something, I have my mic. Laffy is something that I think is, we kind of created this specifically for people like LaDonna Weiss, because she loves education and learning and stuff like that. Karen, these are the things that we wanted to come out with so you guys would have tools. Costs nothing, okay? Right. All it is your time to come out. So we build a relationship with Pepperdine University, sign a 6-month contract with them, and we're going to be offering free educational workshops around retirement, all right? There'll be times on taxes, Medicare, Social Security, retirement readiness, life insurance, annuities, everything you can think about that you need to know about finances. Estate planning, we'll be talking about Medicare. We'll talk a little bit about something called DST, Deferred Sales Trust. Many of you guys have real estate in here that is highly appreciated, and you want to be able to get rid of it without paying the tax. And so the first thing you think about is, I don't want to necessarily sell it and pay the capital gains. Well, deferred sales trust gives you the way to bypass those taxes and help you avoid paying the large tax liability. So we'll be having these classes going on. So visit our website. You guys can go to LAAFE.com, so Laffy.com. Again, register on site. It costs nothing to show up. Because you guys are all clients, you guys can come in and take advantage of it with no charge to you at all, okay? And so, again, it's at the Howard Hughes Center, Pepperdine University over there. So feel free to come out and take advantage of it. Tell people about it. This is a great way we're doing this. It's our nonprofit, and I think you guys will really enjoy it. Sure.
Great, great. And so the ones that are happening this week, it is Wednesday the 25th from 6 to 9 p.m. and then Saturday morning the 28th from 10 a.m. to 1 p.m. again at Pepperdine. And like you said, LAAFE.com. And you can register right there on the site. Again, a great type of event to bring a friend to, and we're going to be covering topics that you guys want to know about. And with that, I want to say thank you guys for coming today. Oh, wait, that's it? There's more. Not done yet.
Last person. So, you guys all agree that there's probably a lot of scams out there in the world right now when it comes to elder people and so forth, right? So we have to do a lot of education behind what's good, what's bad, what's happening, and kind of informing you. So those of you guys who know Delilah, my wife in the office, her primary focus is around compliance, okay? I'm not the compliance person at all, okay? But she's the one that goes to all the classes, goes through all the documents and training that she has to go through, reading all the legal mumbo jumbo. I won't say that. Cut that off on the the mostly informable stuff that we need to know about, right? But this is what she's gonna. So she has a couple of things she wanted to talk a little bit about when it comes to the compliance side of what we're doing. Okay.
Yes.
Thanks.
So Cory actually joked about responding to our emails, and compliance can shut us down if we are not compliant. So we are highly regulated. We have examiners who come in to make sure that we are doing everything correctly, morally, ethically, because if we are not, you will no longer be clients. So I am the one who is in charge of all of that. So if you choose not to do a review, and in just at least one annual review is all that the regulators are asking, because you trust us with your money, your hard-earned money, and they want to know that we are doing our job. So please, if you choose not to have that annual review, sign off on it from our office, letting us know so that the examiners know that. Now, as far as the phishing scams, when it comes to emails, we know that people are going out there just to, I don't know, try to get money. What we ask of you is if in fact you get an email and it comes from Cory and it says EFC Wealth Management, or it comes from Sherry, just double check. Give us a call. It doesn't cost you a thing unless you are being scammed. So please give us a call, let us know, hey, I got this email, let me know if this is from you and if it's valid. So as far as compliance is concerned, I am on top of it. I work with a consultant on a weekly basis, and our goal is to make sure that your identity, your finances are all secure. So if you have questions about that, you can certainly ask me. And also at this point, I just want to say that we are absolutely grateful that you made the decision to be with us on this gorgeous Saturday, because I know we could all be doing anything else, and you chose to be with us. Mark had mentioned earlier the word joy. And as I was greeting you, I actually felt that. And we would like that to happen more often than not. Initially, we were thinking, who's going to show up this time? And to see this room full of all of you, that we worked so hard to provide the service that you expect from us, it means more than you know. And earlier, Cory had provided or awarded us with trophies. And unfortunately, on my part, and I think everybody else on the team, we did not get a trophy for Cory. He gave me a trophy titled Indispensable. And I am biased because he is my husband of 25 years. He's been my partner, my best friend. And the word that I would say about Cory to describe is irreplaceable. He leads. Without him, there would be no EFC. I've been by his side more than 26 years, and he has had a vision. He has a heart of service, of helping people, and he is constantly wanting to be better for you, because he knows he has experienced families who have suffered with financial devastation. And what he wants most, he mentioned earlier as well, is for you to be happy. And we had heard a speaker say, that's all that we all want in life, is to be happy. And I think you would agree with me that finances is a big part of being happy, right? So again, we're all about communication. If there is something that you want us to improve in, let us know. We're not going to take it personal. That's the only way that we're going to get better. For you, we love you. We're on this journey long term, and we want to see you and your families enjoy life as you've worked so hard to earn that money. And, you know, it's amazing to see the families who are now in retirement. And Cory, again, he joked about, you know, we don't hear from you. But for you to participate in our events lets us know that you actually care. And we want you to socialize with each other. You may have brought people into our community, but who knows? There might be someone who worked at the same company that you did, and you never came across each other. So get to know one another, and that's our time together. As throughout the year we have events. So, you know, we have a big one coming up at the end of the year, and I would love to see the room doubled. But again, you know, as you love on us, we want to love on you more, and we appreciate you, and we want to be here without you. So thank you so much for all that you do for us.
That was amazing. Oh my God. You're good at this. Anything else? Nope. Because I don't want to close it out and then you.
One more thing. No,
more. So I ditto everything that Cory and Delilah has said. It is a joy to serve you. It is an honor to be in your lives in the way that we are. We really appreciate you trusting us to take care of your financial resources. And I look forward to just growing and beyond. And thank you in advance for all of the people that you will bring into the EFC family. We really appreciate that.
So.
Was that? There is one more thing.
So I just want to get a shot with everybody in it. That's all. You know? I'm going to shoot a video. Everybody see me behind? Everybody can wave? Yes. So lovely. Wave. Yep. Good stuff.
And with that, it's a wrap.
Yep.
All right.
Thank you, guys. Good. Glad you guys enjoyed it.
You know, I got my date mixed up with Robin. That's what it was. Because I asked her, I said, you're going to be out of town on the 20th.